Today, we are looking forward to chatting about where we are in this overall market. Fed on its rate hike path, inflation that's peaking, what clues we can be looking at in the current market for some signals about the direction. There's been talk about, is this just a bear market rally? Is it something that can be more sustainable? So Harold's going to talk to us about some clues that we can look at to help tip us off about the market's direction. Then we're going to drill down and talk about portfolio management strategies, because we want to be able to sway with the market direction, increasing exposure when appropriate, decreasing exposure when appropriate, and taking our clues from the health of the overall market. And then once we've talked about portfolio management strategies, then we need to know what industry groups we should be focused on, because we have seen some interesting moves underneath the surface, groups rotating in and out of favor. So we'll talk about that a little bit. And then finally, we'll talk about stocks to buy, stocks that we should have on our radar, our watch list. When's the right time to buy? Add exposure and take profits. So that's a little roadmap of the session today, Harold. But I want to kick it over to you. And so let's talk about that big picture of where we are right now in the market.
Well, big picture, the market has been very strong the last 5 or 6 weeks. However, we are still trading below the 200-day moving average. So for me, the way my approach to the market is, as long as we're below that 200-day moving average, and notice if you have a chart in front of you, that 200-day moving average is in a downtrend. And as long as we're below that moving average, I'm treating this rally that we're in as a bear market rally. So I'm still active, but I'm not looking for any type of long-term sustained move until we make it up above that 200-day moving average. So yesterday, we did have a little pullback. We had a lot of reversals in the indexes and some leading stocks. Today is looking pretty good so far. But as far as the overall market is concerned and my approach, I'm treating this as a bear market rally.
Mm-hmm. But like you said, you're still participating. You can't ignore the last couple of weeks of strong gains. But then I think it comes to, okay, what tactics are you using? Knowing that it's a bear market rally, or with that thesis, at least at this time, it seems like that has an impact on not only how you're positioned in terms of portfolio exposure. This isn't the time to be on margin or anything like that. Correct. But where you're entering positions, how big those positions are, and your approach to taking profits.
Right. And the reason why I'm approaching this as a bear market rally is we saw back in March, we had a very strong uptrend in March. Stocks were moving, stocks were breaking up. Well, we got right up to that 200-day moving average. We hit that and then reversed down to the downside. So there's always that possibility that could happen again. So I'm being cautious. At the same time, I'm being aggressive, but cautious because of that 200-day moving average.
Mm-hmm. So some great tips there for active investors. And more on the overall market, how do you think about those different macroeconomic factors and maybe some secondary indicators? How is that weighing into your overall strategy as well? Or is it mainly, let's see how the market is reacting to all of that, which there's been a change in the tone over the last couple of weeks in terms of how the market is handling all of this news and data that we're seeing on the macro front.
Yeah, I mean, there's always a lot of news, whether it be domestically, internationally, whatever, interest rates, all kinds of things that are out there. I tend to focus in on the indexes and the market itself, because regardless of what's out there, we know something is going to happen, and whatever happens, it's going to be reflected in the indexes. So if there's good news out there, the way the market interprets it as good news, we should see an uptrend move to the upside, and vice versa. If the market interprets news that it's negative for the market, then we'll see a move to the downside. So rather than trying to figure out what's going on internationally or domestically as far as policy, or we got the war in Ukraine, etc. rather than trying to look at all those different things, I just like to keep it as simple and focus on what the market is doing. That'll tell me what the market thinks about all these domestic issues or international issues.
So that 200-day moving average, a key level for you. And another technical level we've been looking at is a trend line that can be drawn from the highs around late 2021, connecting to where we did bump up to resistance, as you were mentioning, in late March. We've now, just in the last couple of days, gotten above that. But again, that doesn't mean that we are out of the woods. There are a lot of resistance levels after such a big downturn that we've seen for much of the year. A lot of hurdles to get above on the NASDAQ, 13,000, which is right where we are now. And then again, we have that 200-day line to contend with. So anything besides that would make you feel more confident about adding exposure in terms of where we are in relation to other moving averages that we are above? How should we take a look at those?
Well, we are getting pretty extended above the moving averages, primarily the 50-day moving average. We keep a sharp eye out on where the indexes or individual stocks are trading relative to the 50-day moving average. So we're well above that on the indexes. Also, the 21-day exponential. That's something I keep a real sharp eye out on, whether it be a stock or the indexes. So we're well above both of those. That's what's causing me to pull back a little bit. Again, I'm still looking for things to buy, still looking to put on positions, but at the same time, I'm not as gung-ho as I was maybe a week to a week and a half, because we're getting extended above those moving averages. And as I mentioned earlier, we're above we got that 200-day looming over us. It's like, it's like the boogeyman just hiding around the corner, and he's there, but you don't know when he's going to pop out. But as we get up closer to that 200-day, I think that's a time to really ease off on putting new monies to work in the market.
Until we can really see the market prove itself.
Right,
and once
exactly.
we continue to see those signals, then that can help us be more confident about where we're at in the overall trend. And I think that's a great segue, Harold, to more of that talk on the portfolio management side, because you talked about easing off a little bit. So clearly over the last couple of weeks, putting money to work, because we are in this strong trend. And so, looking at those clues of the changing tide before this week, I think is also something to keep an eye out for. Getting bogged down by the negative headlines and using that as your guide isn't what we want to be doing. Like you said, looking at the price action and starting to maybe be cautiously optimistic, putting a little bit of money to work. But let's talk about overall portfolio exposure, because if this is a rally that still has to prove itself, what kind of portfolio exposure is appropriate right now?
Well, I put on a lot of exposure in the last couple of weeks. I can remember I got down to maybe 30% invested. Last couple of weeks, I've raised that, so I'm almost doubled what I was. I was a little over 60% invested right now as we speak here. So I'm at the point where I'll put on a little bit more, but I'm going to keep bringing this up, that 200-day that's looming right above us. So I'm not going to be too anxious of adding more exposure to the market. If you haven't done much, because maybe you were hesitant about the market because of all the news issues out there, I wouldn't be too anxious to put more money to work. Again, as I mentioned earlier, that 200-day is looming up above us here. So a lot depends on what you've been doing the last couple of weeks as to what you're going to do with your portfolio.
And with the strong move, if we are expecting maybe some sort of pause here or pullback, it seems like seeing how the market digests that. If
Right.
we can find support and then rebound, that also might give the opportunity for a lot of stocks that we are seeing that have made those really strong moves over the last couple of weeks take time themselves to digest gains and set up alternative entries, because chasing stocks in this kind of market, especially with where we're at now, isn't something that would be advised. But
Right.
what's
Right.
your comment on that?
All right. So as we talked about earlier, the market is getting extended above the major moving averages. If you look at the market since the June lows, I mean, the Nasdaq is up like 15%. The S&P up around 10 to 12%. I was even looking at this consumer discretionary. That's up, I think, close to 20%. So the market has made a very strong move since the June lows, and this also adds more cautiousness on my behalf because of the move we've made since the June lows. And also you throw in the fact that we are above those moving averages. So what we would like to see is the market kind of pull back a little bit. It would be nice if the market kind of went sideways for a little bit. On the Nasdaq, we're at that 13,000 level. It would be nice if we just kind of went sideways from there and really not do much to digest those gains and then see a further move to the upside. So only time will tell if that happens. So that's why we keep a sharp eye out on the market and a sharper eye out on our positions here. So for those of you who maybe you didn't get the exposure that you wanted, don't jump in now. Wait for the market to at least for the Nasdaq get above that 13,000 level, and then we'll see what happens from there.
Mm-hmm. All right. Well, with the strong move off of lows that we've seen, I think that begs the question: what stocks and industry groups are really driving that strength? And Harold, what do you look at to help uncover those signals of shifting industry group strength?
Yeah, so I use the Growth 250. So in MarketSmith, we have a list called the Growth 250, and the primary purpose of that list is to find stocks in some of your stronger industries. So one of the things I do as part of my weekend routine, I like to see what stocks are added to the Growth 250. So every Friday, a couple hours after the close of the market, that list gets updated. So on the weekends, I will look and see, okay, what stocks are new to that list. I'm not necessarily looking at the stocks, but I'm looking at the industry groups that those stocks belong to. So for example, back in the very beginning of the year, oil and gas, I think the first week of the trading, there were no oil and gas stocks on the Growth 250. But then by the second week of January of this year, I saw about 35 names show up on the Growth 250. That was telling me that institutions were putting some money into that sector of the market there. And of course, we all know the first five and a half months of this year, oil and gas that has been the leading industry. Back in June, oil did kind of sell off a little bit, along with the stocks in oil, like XOM. We saw XOP also take a decline. But what I'm seeing now, based on doing my research using that Growth 250, it looks like we're starting to see more oil and gas stocks coming up, where we had quite a few added to the Growth 250 list this past weekend, also the weekend before. So it looks like oil is trying to reassert itself to leadership here. And there could be some reasons behind that, but again, I don't like to look at why something is working or not working. I just look at what's going on with the charts, what's going on with the fundamentals, and then I act accordingly.
Mm-hmm. So utilizing the Growth 250 and seeing what's moving on, what's coming off can help you uncover that industry group shifts. And also looking at these ETFs can be sort of a proxy for what we're seeing.
Right.
Lately, we've been talking a lot about biotech stocks and looking at the improving relative strength there, even at the lows, sort of the subtle signs. I can pull up an index line here just to compare this. So when we saw the S&P undercut its lows from mid-May. In mid-June, we did not see an undercut of the lows for biotech stocks. So it's, even though at that time it's still not a good looking chart, still in a downtrend, that's one of those subtle signs of relative strength that got something like this on our radar and has now, since then been in a nice uptrend.
Yeah. So as you've shown on your charts, the you saw a downtrend on the S&P 500, but the relative strength line for XBI, it kind of flattened out. So that's a sign of some relative strength. And it was kind of strange because typically biotech, that is a very risky part of the market. And when a market's in a downtrend, there's usually more of a flight to safety rather than risk. So it's kind of strange that, okay, at least that was the way I was looking at it. It's kind of strange that biotech was in favor. But like I said a couple of times already, I don't try to figure out why. I'm just looking at what's moving, what's working, what's not working. Biotech was working. So that's where I've been putting some money into it. And especially biotech, I prefer the ETF like this XBI or IBB is another one because biotechs can be extremely volatile because all it takes is a some type of downgrade or maybe one of their drugs have some type of unexpected negative effect and the stock sells off, it could pull down the entire industry. Just having ETF exposure, you don't have that risk, overall risk that an individual stock will have.
Mm-hmm. And when Ken Shreve was on Barron's Live with me, we were talking about IBB and XBI a little bit earlier. So it was at least a month ago. And we've seen some nice moves for these ETFs since then. Harold, anything else that we need to know about how to uncover that market leadership? Because I think as individual investors who are active, I mean, the reason why we're doing that, why we're actively managing our portfolios is because we want to outperform the market, right? So focusing on stocks that are doing that is something that we really want to be doing.
Yeah, so I found that oil and gas has been doing well, but one of the ways that you can find leadership is to constantly be engaged with the market. Okay, when the market starts to sell off, what a lot of people tend to do is say, "Oh, okay, I'm gonna take a break. I'm gonna back off." And when you do that, you're losing engagement. You need to stay engaged with the market. I like to use the analogy of a sports team. There's times when you see a sports team, they might have, be down a lot of points in basketball or football, but they come back and tie the score, maybe eventually win the game. That's because they are staying engaged. Well, we as investors need to do exactly the same thing, even though maybe our portfolio is not doing so well, the markets are not doing so well. You got to stay engaged, and a part of that engagement is when you start to see things like oil and gas. You start to see a lot of things like some of your medical stocks. Those have been doing well. Pretty much the energy sector is doing well also. So just being engaged with the market is part of what you should be doing to identify areas of strength in the market.
Yeah, that's a really good point because I think if you're not staying engaged, then you're going to perhaps miss some of the explosive movers that we've seen over the last couple of weeks. And then your timing is off. So then it goes back to the overall direction of the market. So having a pulse on what's going on can help you stay in step with the market. And speaking of big movers lately that we've seen, Inphase. So you mentioned energy, and that's not limited to oil and gas. We've seen solar stocks really catch fire, ENPH, the big leader here, and the recent run sparked by its quarterly earnings report. And even though solar stocks have been somewhat volatile over the last couple of months, this relative strength was another clue that put something like this on our radar even before that earnings move was very explosive and
Yeah,
had an
yeah.
impact on the price here.
Yeah, this is one I'm kicking myself over because I had an alert set right where you drew that horizontal trend line, and I didn't do anything with it, and kind of kicking myself. But hey, you can't buy everything, and even if you could, who's got the money to buy it? But uh, Inphase is definitely one of the leaders in today's market, along with TAN. That's also doing well. TAN, that's an ETF for
Mhm.
the solar industry. Uh, uh, SEDG, I forget the company name. That's the ticker symbol. That's also a solar stock. Yeah, Solar Edge. That one did have some rough going a couple weeks ago, but it looks like it's recovered and it's making its move to the upside. So something like the Solar Edge, if you want single stock exposure, this is something that's setting up pretty nicely here. And as you mentioned a moment ago, solar is also doing well. All part of the energy sector. The energy sector overall is doing very well. You've got oil and gas on one part of that energy sector, and then you've got
Mhm.
uh, solar as the other part that's doing well.
Yeah. And one more note on Enphase, because I think this is also instructive from a portfolio exposure standpoint, and also says a lot about where we are in the current market. In 2020, traders of our flavor wouldn't really hesitate to buy a strong move up on earnings. But the kind of environment that we've been in is one that up until lately hasn't really been rewarding that strength. It's been tougher to really buy stocks into strength, and especially something like this that had a track record up until then of being pretty choppy and volatile. A lot of fits and starts here. But at the very least, if we did miss this, because discipline also really important in the stock market, is that seeing stocks have more success into strength and building off of that. Celsius, CELH, another example, CELH, very different industry group, but also a strong run in recent weeks. So also the stocks that you missed, Harold, what does that help tell you about what we're seeing underneath the surface as encouraging clues, perhaps, about overall market conditions?
Yeah, so even though I missed on Enphase, I was at least looking at the right thing. So
Yeah.
I'm happy about that. What you want to see with Enphase is what you're seeing now with Celsius. So if you pull up Celsius, Celsius had that really strong move to the upside, and now it's consolidating, going sideways a little bit. So who knows? In the next maybe week or two, this might form maybe like a 3 weeks tight pattern. It's a pattern that we like to use to add to a position. A 3 weeks tight pattern, I like to consider it a continuation pattern. Typically, what happens, a stock, it'll break out, make a move to the upside, consolidate 3, sometimes 4 weeks, and then make another move to the upside. So Celsius might be doing that. So that's what you want to see with Inphase. So even though I missed Inphase at the breakout, I'm waiting to see if it's going to consolidate its gains, just like Celsius.
Mm-hmm. All right. So now that we've talked about different industry groups and also leading stocks, I think now, Harold, a question is, well, how do investors know if you've missed a stock? Because, why shouldn't I just buy Inphase right here or Celsius right here? If we want to go with the momentum, why not right now? And I guess that then shifts over to a question about making sure you have that risk reward in your favor.
Yeah, yeah. I mean, we have no stock is going to go up forever. Okay, so this stock is breaking out and it's made a really strong move to the upside. So again, we know that nothing's going to go up forever. Here's where it takes some discipline and having some rules. So as I mentioned a moment ago, what we would like to see with with Enphase is a consolidate, just like we see with Celsius. Yeah, it's tempting to get into a stock that's run up like this, but you could be exposing yourself to eventual sell-off. This stock is up. He was looking at Inphase, 54% from its breakout. So uh, again, nothing's going to go up forever. The stock is what we call extended, and It's too late to be getting into it now. I think you're just taking on too much risk if you try to get into the stock right now.
So if we need to be keeping our watch lists fresh for potential stocks to buy, if the market continues to hold up, which again, we're kind of in a position right now where we have our foot hovering over both the gas pedal and the brake.
Yeah.
we're not on the accelerator, but we're not slamming here. We're kind of coasting. We have some exposure in the market, but I guess going back to your basketball analogy, if I may, something that we've talked about in the past is you have to be nimble to switch from offense to defense. We've seen a strong couple of weeks. We could see more strength. We could start pulling back. So we have to be ready for those different scenarios. And so I think with that, making sure you keep your watch list fresh and up to date is super important. What would you suggest would be the best way of going about doing that and uncovering those top stocks to potentially buy?
Well, first off, when it comes to building a watch list, I do the same thing every day, every week, regardless of what the market is doing, because that's part of my way of being engaged with the market, is just looking at the indexes, looking at stocks, and it doesn't matter what the market is doing, because again, I want to stay engaged in the market there. And so for now, as you mentioned, and I was thinking of another analogy, how if you're ever driving down the highway, you're going 75, 80 miles an hour, but down the road, you see there's some heavy dark clouds. So okay, there's something coming up. So you'll lighten up off the accelerator a little bit, but you're not going to stop. Yeah. So I think, and those dark clouds, in my opinion, is that 200-day moving average that's hovering above us. So I know that probably didn't directly, I forgot your question.
No, that's great. Yeah, we have to build our watch list, but doesn't mean that we're going to load up the shopping cart.
Right, exactly. So you want to build your watch list with fundamentally and technically strong stocks, because these stocks, if the market does hit that 200-day, who knows, we could go sideways from that and we could break out above it. Well, if that happens, stocks that have the strong fundamentals, stocks that have the strong chart patterns, those tend to be your leaders in the market. So you always will be ready, have that watch list ready with fundamentally and technically strong stocks.
All right. Thank you for that, Harold. And now let's get to some viewer questions, which we do really appreciate. And if you are joining us live, submit your question and we'll try to get to a couple of these. We have a lot that have poured in, so we'll do our best. The first one is from Paul, and he's asking, where do you see miners, steel, and fertilizer stocks heading? So I guess the first thing that we can do is bring up one of the metals and mining ETFs, and that is XME. Quite a few up days here I'm seeing on the chart, Harold. Volume, though, is pretty light, and this is a group that's been out of favor up until recently. Maybe some money flowing in, at least. Prices improving here, but a lot of money that flowed out of this group from late April to just a number of weeks ago.
Well, the way I'm looking at the metals and mining, I think metals and mining are where oil was back in 2020. Remember, oil went negative, and they're paying some very high dividends just to attract investors. But I think mining, because of this move to pretty much worldwide to go green, these type of stocks are going to do well, because you need materials. To build a solar panel, the materials in a solar, they have to be mined out of the ground. To build an EV, I was reading something not earlier this week where an EV uses 6 times more commodities than a combustion engine. So these mining companies should do well in the coming years because of this push in this move to go green. And we got to have those materials, got to come from somewhere, and they have to be mined out of the ground.
And then I think from there, then you always want that story, right? That fundamental reason. And then from there, it comes down to mashing that up with what the chart is telling you.
Right. So this chart that you have now is showing you that, okay, mining this ETF is starting to make a move to the upside, getting up above its 40-week moving average there. So that's a bullish sign for a stock. I've been buying stocks that have been making up above the 200-day on a daily or the 40-week. Apple is an example of a stock that I've done that recently. XBI is one that I added to my position because it got up above that 200-day moving average. So that XME is doing. So you see how it consolidated, had a nice move to the upside.
Are you talking about XBI?
XBI is doing, I think that's what we're looking at. But yeah, XBI had a nice move to the upside, made it up above the 200-day moving average. It's consolidated a little bit. That's what you want to see when a stock does make a strong move, and hopefully it'll continue making a move to the upside. So this is what you want to see with XME. You want to see a similar action there. So ideally, what you'd like to see after that move up above the 200-day is the stock kind of consolidate a little bit, digest those gains, and then continue making a move to the upside.
All right. And so, Harold, we've talked about setting up our watch list and looking at potential stocks to buy, and when stocks are gone up and out of there, like Inphase and your Celsius, and needing to wait for another opportunity for the stock to maybe settle down and set up again. But what we haven't covered yet today for our Barron's audience is when to sell a stock. So Philip is asking, when should we be thinking about selling?
Selling is actually more important than buying. I've heard a saying, it's not what you make, it's what you get to keep. And knowing how and when to sell a stock is extremely important. Now, when you sell that stock, all depends on when you bought it. So that's also, it has to take into consideration. So, we just can't give you a blanket answer as to, well, you sell it this way. Well, again, it all depends on where you bought it. So, but you do definitely have to have an exit strategy, no matter what you're buying, whether it be an ETF, a mutual fund, an individual stock. You got to have an exit strategy. And sometimes it comes down to just drawing a line in the sand. You might have a 15%, 20% gain of the stock, and you say, okay, you know what? If this stock pulls back to the point where I just have a 17% gain, then that's when I'm going to either sell the entire position or I'm just going to take a little bit off the table. So bottom line, it just comes down to just making a decision. But a decision is better than no decision as far when it comes to selling, because what we see a lot is people, they don't have any sell rules, they don't have a sell discipline, and they watch the stock go up and they end up giving back some or all of their gains, and that can be very frustrating, not only to your portfolio, but more importantly, your mindset. So you got to have some sell rules there.
Totally agree. And I would encourage the audience to check out one of our archived Barron's Live episodes where Scott St. Clair and I talked about some of those offensive selling strategies. So on the upside, say you get in right and you have a nice gain, it is a tricky question, and there isn't a one size fits all answer, but there are there are some strategies that you can utilize. So I would recommend checking that out. And then on the downside, Harold, as active investors, we definitely don't want our losses getting out of hand. So like you said, having that line in the sand, making sure your risk reward is in line when you're getting in the trade in the first place. And that's why we use looking at charts, looking at price levels and those moving averages to help answer some of those oftentimes difficult questions.
Right. So your decision to sell is all based on the chart, not the fundamentals. You just throw out the fundamentals once you own that stock, because fundamentals, they only change once a quarter. So a stock can have a drastic decline in price before those fundamentals change. So you're using the charts, you're making a decision to sell a stock. As I mentioned earlier, as we're getting close to that 200-day moving average after a strong move since the June lows, now is a good time to be selling into strength. You don't want us, I'm not waiting. Sometimes I'll wait to see, okay, yeah, we're hitting a area of resistance like the 200-day or some other level. I'm just going to wait and see what happens from there. But in this market, I'm taking the money and running. So
Mm-hmm.
selling into strength, that's something that we like to do. Selling in strength just means as the stock is moving up in price, we're just going to take some monies off the table, either sell the entire
Mm-hmm.
position or 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 just part of the position. On the other hand, let's say you bought a stock recently, but it didn't work out. We have a sell rule that states if the stock goes down 7 to 8% from where you bought it, then that's where you should sell. But you
Mm-hmm.
don't necessarily have to wait until if it's down 5%, you just don't sit there and say, okay, well, it's down 5%. I can wait 7%. No, you might just say, it didn't work out right away.
Mm-hmm.
I'm going to sell the stock now, keep my losses as small as possible. That is the key to investing, is keeping your losses as small as possible, because I don't care who you
Mm-hmm.
are, you're going to have losses. And the key to making money in the market consistently over the long term is having a sell discipline.
Yes, absolutely. And I think it would be helpful for our audience to share a real life example about setting stops and then also position sizing. So John is saying how to set a stop loss price. So maybe Harold, you can walk us through how you figured that out for yourself with the Apple trade. You said you got in when it got back above that 200-day line with earnings out of the way, had some volume behind that 3% gain on the 29th of July. And then also related to that, we had another question from one of our participants about, from Ernest, about what's the minimum one should invest in order to make a decent profit. So a position sizing question there.
Yeah. So as far as position sizing, there's a standard in the industry that you should put no more than 5% of your overall portfolio into a stock. I know here at IBD, we tend to be a little bit more aggressive than that. We might, for us, 10, 12%, we consider a full position. So you have to do what allows you to sleep at night. So 5%, if that allows you to sleep at night, you don't want to go 10% because that's going to keep you awake. Well, then do 5%. So whatever allows you to sleep at night, that's what you want to do. But you definitely need to have some rules as far as how much you're going to put into how much of your portfolio, percentage-wise or dollar amount, either way will work. But you need to have some type of rule as to, what portion of your portfolio you're going to dedicate to an individual stock. So if that stock happens to blow up, your entire portfolio doesn't blow up.
Mm-hmm. So here with Apple, Harold, how did you determine what position size you were comfortable with, and where was your line in the sand when you initiated the position, your plan, your exit strategy for that, and where are you at now with that?
Yeah, so Apple, this is a stock that I've been trading actively for a long time, more than a decade now. So I know Apple very well. So I took a larger position than I normally would because I'm just very familiar with the stock. So once we got up above that 50-day, or excuse me, 200-day moving average, I started out with a 50% uh, um, uh, entry into the stock there. So 50% of my portfolio size. Now, normally that's what we normally do, but because of the market, I've been lowering that initial entry. So with Apple, I start out with the 50%. I set my loss. You see that gap? So what I do is I look at the low of the day that it gapped up, and I look at the number and I calculate 2% below that. So that's my stop. Now, how do I arrive at 2%? I don't know. A number I just came up with. I like to see, if the stock gets down 2%, most likely 2% below the low, most likely it's going to continue down below that. So that's what I found over the years. So that was my exit strategy. It came down too close to that low, but it recovered and made a move to the upside. So right now I'm in pretty good shape with Apple. So I will be looking and see, okay, well, what's it going to do from here? Right now, it's kind of like in no man's land. It's far away from the moving averages. There's really no support or a resistance area that are close by. So this is something where, okay, I might just have to draw a line in the sand. Maybe I do so around the, I don't know, 170 area as a place where I say, okay, you know what, if stock gets down to 170, maybe 165, then I'm going to start taking some monies off the table because this is something I don't want to round trip it or coming close to round tripping.
All right, Harold. Well, as we wrap, any other final words of advice to our audience about how to handle the current market environment, which it's been a very tricky year. We are seeing things improve. And I know you've got your eye on that 200-day line, which is going to be a big test. Some individual stocks have successfully passed that test, at least in the short term, like the likes of Apple. But your final thoughts here?
Well, my final thoughts, as I mentioned earlier, I'm considering this as a bear market rally, and the rally has been very strong, but that 200-day is looming up, over us here. And I know I kind of sound like a broken record. I've mentioned that several
You're just
times during this.
emphasizing it. You're
Right,
emphasizing it,
exactly,
Harold.
exactly. But I just want people to make sure that people are aware of it, that we're to be careful that, okay, we're getting up there. Not necessarily slow down your buying, but well,
Just be
yeah,
aware
you
of
want to slow down your buying.
it.
But as far as advice, I also mentioned selling in the strength. So if you got some profits in some stocks, take some money off the table. So if you have a 20% profit, say you bought 100 shares of XYZ, take some off the table. Take off 25%. 60. 30%. Do something. Just don't wait for it to start declining, and then you're giving back too much. So I would say for stocks that you have profits in, sell in the strength, take some profits, lock those in, and see what happens with the rest of it. If it keeps going, okay, you've got some money working for you. If we get above that 200-day moving average, well, you can look to start adding back what you took off. So I would say, number one, sell into strength. Number one. Number two, have some sell rules, okay? And then number three, just stay engaged with the market regardless of what your portfolio is doing, because you always want to be prepared. We're going to have an uptrend again, or a continuing uptrend, but you want to be ready for it. You want to be able to hit the ground running rather than trying to do a catch-up.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.